Hello, everyone, and welcome to the Coach's Playbook for June the 9th, 2020. Said that very slow because the years are weird when you say 2000 first instead of 2020. Hell of a year it's been. Today we got a great topic. We're talking about calendar spreads and the roll, which is on top of everyone's mind because equities are rolling this week, and you only get a few of those each year. And but first, we wanted to give a shout out to the over 2,000 funded traders that we have already funded in 2020, which I think at this point we're above 2020 traders in 2020. So didn't see that
That's pretty
happen.
wild.
Exactly. And then Mick, you had a shout out as well.
Yeah, well, shout out to the 2,000 traders that passed step two. It's been a busy year for us. Volatility created a lot of opportunities. So, we're well above where we were at in 2019. So shout out to everybody that's, trading well. I do have a individual shout out, guy Scott Caplow. He's about $3,000 today trading both the gold and the equities. So, he's got a great eye for the markets. Happy to see him doing well today. And right before we got on, I think we were talking about how he's going to be doing an interview with you guys pretty soon, correct?
Already have one. So if you go onto our YouTube page here, you go into the Funded Trader playlist. We did an interview with Scott actually last year in the office. So you can learn a little bit more about him there.
Yeah, he's got an interesting history, in the financial business too. So,
yeah, speaking of mildly interesting things, I have a cheap cigar here on my filming rig because we were doing a Last Dance retrospective with some of my high school friends. So we all had to have the little cup and the cigar. It was a long Thursday night, but I have since recovered. And it's time to talk about the roll, the real good stuff. So I was thinking maybe, Hogue, you could get us started because you have a lot of experience over the years doing the roll and the calendar spreads.
All right. Well, rollover really just indicates that the current front month is going to be expiring soon. And anybody who wants to maintain those positions that are currently in that front month, which is expiring, needs to move those positions into future months. In the trading pit, there were specific physical areas where certain months were supposed to trade, and all of those would switch. And many of the discretionary day traders in the pits would find that week or two of rollover particularly challenging. Markets tend to act a little bit more differently because I think a lot of the longer term traders, the real money behind these markets, their focus becomes a lot more on trying to get a cheap rollover than trying to maintain directional activity. So markets tend to range a little bit more during rollover. Volume is a little bit blurry during rollover because if you're depending on the volume in the front month to make any trading decisions, well, volume is naturally going to fall off in that front month as more of the positions move into future months. And then think about this. Crude oil rolls every month. So about 1 week of every month, the focus for our longer term traders is really on making sure they get a cheap rollover. Now there's two ways to do that. One way we're going to be talking about today is in the calendar spreads. Another way is to leg the position, which means actually, getting out of the current position and then re-entering that position at a different time in a future month. So just kind of a glaze over of what the rollover is and what it means to discretionary day traders like us.
Yeah, and I want to pop in on just the calendar spreads versus the legging. I would say that the calendar spreads is probably a safer way to do the roll.
100%.
Because if you're legging, there's a chance that you only can do one leg, and when it comes to doing the other leg, you might have to chase the markets a little bit. So what the calendar spreads are in general is there's a market for these contract months where instead of just trading, July crude oil, you can trade the difference in price between July and August crude oil, and it's actually quoted as the difference between those markets. So you could have a positive price difference in a market like crude oil. In a normal market, you usually see that quoted as a negative, meaning that the front contract month is a little bit less expensive than the deferred contract month, whichever one that you're trading, because you can do calendar spreading. You don't need to do July, August. You could do July, November. So you can trade all the pairs, as they call them.
Yeah, and just for clarification here, when Mick's talking about legging, when you're doing that, you are literally just going to sell one contract month, and then it's your job to go buy the next contract month. So like what Mick was saying there, you can get out of the one position and you're trying to roll into that next one, and the market could spike in one direction or the other. And maybe sometimes it works in your benefit, but odds are usually against us when we're trying to do that. And so when you have that option to calendar spread, it's really nice. You can get in there, you're selling the front month, buying the back month, or vice versa, however you want to go about it. And that way it carries that position over. I know for us, when we were rolling every couple of months in the treasuries, it was a big deal for us. It would take us quite a few days, almost a week and a half even sometimes, for us to actually get our whole position rolled over, making sure we weren't getting hurt on price.
Yes, I think that that's probably a good piece of information for the day traders out there to take away, is you never want to be forced into doing a trade that you're not confident. You're just kind of doing it because it's something that needs to be done. Because I was also a treasury trader where we had a lot of spread positions. We'd have to roll a bunch of stuff. And I wish a lot of times I had just gotten flat and started again, because it only happens every 3 months. Mick, you did a lot of calendar spread trading. It wasn't something we were doing. So it was just kind of this free for all of I'm going to roll the position like this, like that. And, if you're legging it, you're just taking outright positions. It was kind of throwing, at least for me, it threw me off my game. And I would find myself just kind of like chasing and not making wise decisions about the roll.
Mm-hmm.
So
I'm right there with you, Jack. I used to have, you're rolling 200 bonds from 1 month to the next. And I feel like I would spend a week to a week and a half just sitting there focusing on making sure I can just get my bonds transitioned into the next month, as opposed to focusing on my actual trading.
Oh, and I can't tell you how many times that you would leave, you'd try and sit on the bid or offer in the calendar spreads just to get, because you want that little bit of a better price, and then you're just chasing it.
Right, and you're only getting filled one at a time because they're not trading as much. And
the volume on them, yeah.
But it's a fun concept.
I want to jump in and say, so we started off talking about the roll and how people can use calendar spreads for the roll. I think our audience has a good idea of what the roll is. Everybody in our program, they're required to trade the front month contract. So people use calendar spreads for rolling positions. Doesn't mean that you can't trade calendar spreads to make a profit. Start trading a calendar spread and exit that trade using the same calendar spread pair. So people do speculate on these things. And as the name suggests, calendar spread, some people like trading only calendar spreads because you are spreading your risk. When you're long 1 month and short another month, you are spreading your risk. You don't have exposure to, traditionally you don't have exposure to large movements. However, yes, definitely crude oil comes to mind. Those spreads can get very, very volatile. But usually when you're long 1 month and short another month, you see some smaller price movements in those, but not always, that's for sure. I've seen some wild spread movements in the grains. We saw it with the May, June crude oil, May crude oil compared to any other contract month of crude oil. So I don't want you to have the wrong impression that there's no risk there or always less risk. But typically people that are trading those spreads, they do a little bit larger size and try and make smaller profits. When I was with a proprietary trading firm, we were market makers in the grains. So we were trying to, buy it at 1, sell it at 2, and do that as many times as we possibly could throughout the day. We wanted to make 1 tick profit on as many contracts. And if it looked like the trade might go against us, we wanted to scratch the trade. We didn't want to lose even 1 tick. So we might very regularly, we would take a trade off exactly where we put it on if it looked like, we were long and it might go offered. So that was something we tried to do. And as far as, some people, market making is not the same as scalping. Market makers are in there making a market. Scalpers, it's just short time frame trading, in my opinion. But we were trying to make a market, and we were sometimes in and out quickly, other times we weren't.
Yeah, it's a slightly different type of trading than we tend to advocate for outrights, where we talk about finding asymmetric opportunities, where you can make a lot as opposed to losing a little. When you're doing these huge spread or basis trades with a lot of size, trying to get a tick or even a quarter tick. I remember we used to trade the 2-year basis, which is the 2-year futures in treasuries against the 2-year treasury cash, and they hardly move. But there's nothing more terrifying than one of those things starts going against you, because it is a rush for the exits and you have a lot of size on.
Well, right. And with the lot of size and trying to only make one ticker scratch the trade, we could do that in the calendar spreads. Sometimes you get caught on the wrong side of the trade, wrong position. But, in order to do a lot of size in just a regular contract month, like November soybeans, for someone, all these contract months move pretty quickly. To try and say you want to buy 200 soybeans, risk maybe no ticks to make one tick, it's completely backwards risk. Because if anybody's watching, maybe not the soybeans is the best example, but if I wanted to do crude oil and try and make one tick on 200 crude oil, you see how much the crude oil moves around. I could be risking 10, 20, 30, 40 ticks to make one tick, and it's just not there. But the spreads move more slowly, usually.
Yeah, that's a really good point, Mick. And I just want to touch on something Mick kind of mentioned a little bit ago. People use it to kind of help manage risk in a sense. One of the ways a lot of traders that are using this, they're using it, and the term is hedging. I think you guys have probably heard us talk about hedge your position a little bit, cover that risk. And that's what people use these calendar spreads for as well. Sometimes you're not really sure, or you're trying to make a decision on the direction of the trade. You can cover against yourself saying, look, I think it's going to be long. I want to buy a calendar spread. And then you can start to manage that risk a little bit, so that you are at least protecting yourself when the market goes against you.
Yeah,
Absolutely.
it all comes back. In a broader sense, this all relates to what we talk about constantly in risk management, which is you always need to know how much it is you're risking, and be fairly confident that you can stick to that. In As we said, in outrights, that's usually a lot simpler, but it's the same principle, even if you're not trading calendar spreads.
And as we're kind of on the subject talking about roll, something I just want to make sure we touch on, because I know it's such a common question. I see it in our Facebook community a lot, and I see people asking on all of our live stuff, how to know when roll is coming. So I want to make sure you guys have a couple ways to look at this. Number one, you can always go to cmegroup.com, and it tells you the exact day there. You can sign up for our weekly kickoff email. We mention it every Sunday, whatever rolls are coming or whatever products are going into roll for the approximate date there. And then lastly, you can always watch just the simple volume month per month, which one is trading more. As you start to see the front month volume go down, you start to see the back month start to go up. That's when you have to start rolling that position, or at least start looking to trade that back month.
Yes. And if you're closing positions each day, like our traders would be in the combine or the funded account, just before you start each day, check which, probably know when it is, but even if you don't, just check which contract has the most volume, and that's the one you're going to want to be trading, has the most liquidity.
Yeah.
Absolutely.
And I want to add something there. There's specific dates where the contracts expire. And then there's estimated dates for when the contract rolls. Now the rolls usually have a certain day that they begin. However, the rolls technically happen when the people who are participating and holding, open positions, open interest, start rolling. So that's really at the mercy of the traders and when they want to do that. So that's kind of what you see. Usually, CME Group definitely is a great resource. I use that myself instead of flipping through a couple month domes on my platform or anything like that. You can just click on the product CL and it lists all of the contract months, and it paints the volume right there. Oh, this contract month's done 300,000 contracts. This one's only done, 100,000 contracts. We haven't seen the volume shift yet. Usually, as a rule of thumb, once you see the second month contract take about half of the volume that the front month contract has done, I'm going to assume that the following day that contract's going to have rolled to the second month.
Great point.
That's a good rule of thumb. Well, is there anything else anyone wants to add in relation to the roll or trading it? I think
One other way you can find out when the roll is coming is try watching the market forecast. We discuss when those rolls are coming in all of the popular products here at Topstep.
that is right. Even though we're all quarantined, Hoagland is still on YouTube at 8 every morning, throwing out truth. And in this world with so little truth, John Hoagland is a man you can trust.
I try.
Well, with that, I guess we've covered, at least at kind of a 30,000 foot level, a lot of the things to think about when it comes to the roll or the calendar spreads. And some of it's just kind of for your information. If you're just trading outrights, just watch that volume, make sure you're rolled when you should be. Dan, do you have a quote maybe that could sum this all up?
I do. So I kind of like this one. Obviously, Jack alluded to it. 2020 has been quite an interesting year. And I know I quoted this guy last week, Martin Luther King Jr. And as I was just kind of scrolling through quotes today, this one kind of resonated with me. And I didn't even realize it was him until after I said, I'm going to use that quote. The quote is, "Out of a mountain of despair, a stone of hope." I like that one.
That's really good. It's a good message of justice for everyone out there. Good thing to think about. And John, would you? I just call you John. That was weird. Hoagland. What do you say you sign us off today?
Absolutely. Watch the rollovers. Markets can get a little bit wily during them. Make sure you get out there and profit. Trade well today.
That's a coach's playbook. We'll see you next week, guys. Have a nice, safe weekend.